Time for our hot pick section of the program. Today we are focusing on consumer staples, and our next guest likes a monster play in the market. Joining us for some perspective is Filippo Falorni, Director of U.S. Beverages, Household Products, and Personal Care Lead Analyst at Citi, which means you cover a wide range of interesting companies. We talk endlessly about, tech and the excitement of all these AI themes. But in the world that you cover, consumer products, give us a sense on what you're seeing first before we get into the picks. Is there a lot to be excited about these days?
Yeah, hi John, thanks for having me on. Look, I think it's clearly an interesting environment at the consumer level. We've seen clearly a bit of softness in the US in terms of consumer trends and consumer purchasing behaviors, with a bit of a bifurcation. The higher income consumer, higher middle income have been holding up better. Lower income consumers struggling a bit more as a result of cumulative inflation over the last 2 to 3 years, and wage growth that hasn't really kept up with inflation. But there are pockets of growth in a lot of different categories that I cover, both on the beverage and HPC side. So look, the overall environment is not great, but there are significant areas of potential growth opportunities.
Well, I think, look, at the end of the day, there's different investors. There's short-term investors. There's long-term investors. And, when you pull out the big gainers in indexes like the S&P 500 over the long term, yes, you're going to see a lot of technology companies. But one that has always stood out to me is Monster Beverage. The energy drink maker has been a home run over the long term, and it remains a company that you're constructive on today. Tell us a little bit more about the Monster story and how it fits into your analysis.
Absolutely. That's one of our favorite names within the beverage space, one of our top picks. Look, the story here is that you have a category that is very attractive. The energy drink category is a relatively younger category within non-alcoholic beverages, right? It really started to develop in the late 90s. And even in the US, which is one of the most developed markets for energy drinks, there are still significant growth opportunities. And these are, in my mind, secular growth opportunities because they are driven by favorable demographic trends. That includes younger consumers really increasing the use of energy drinks as their primary source of caffeine, and becoming much more comfortable of using energy drinks throughout the day, right? Energy is replacing coffee in many occasions, especially the afternoon occasion, caffeine occasion, and especially among younger consumers. The other big value unlock more recently has been expanding across female consumers. Historically, energy drinks were a very male-dominated category, 70-30, but more recently, there's been a lot of new flavor, new innovation. Brands like Alani Nu, Bloom, they've really expanded the category more into female consumer, and that's all incremental growth into the category. And then lastly, I would say, look, even in the US, there's still a lot of distribution opportunity. If you look at the space retail that is allocated to energy drinks, it's still significantly below other much more developed category like carbonated soft drinks. And so the US is really a growth area. Internationally, in many markets around the world, the energy category hasn't really developed as fast as the US, so there's still opportunities both in terms of per capita consumption and in terms of distribution, in terms of developing the category at the shelf at retail. So the category is very strong. Monster, over the last, to your point, over the last 10, 15 years, they've been gaining a lot of share along with innovation. And more recently, they're really increasing their innovation focus, particularly focusing on zero sugars, which is really one of the areas that is growing very nicely within energy drinks. So to me, it remains a very strong growth story, well above their peers, top line growth in the double-digit range, and also very strong earnings growth. They're also in a net cash position, so they've been complementing earnings growth with share buybacks. Okay. So very interesting story in my mouth.
No, that's great. Really in depth. We appreciate that. Now let's compare the Monster story to another well-known drink manufacturer, CocaCola. Hasn't seen the same kind of long-term return as Monster, but known for its dividend payments, which I think juice up the 20-year return to around 500%. And by the way, for big shareholders like Warren Buffett's Berkshire Hathaway, those dividends definitely pay off. What Coca-Cola, traditional sugary drinks, perhaps feeling a little bit of the sting these days. But what is it about the Coke business that is catching your eye?
Yeah, no, CocaCola clearly a much more mature company, so the growth profile is definitely lower relative to a Monster. But within the beverage space, it's still one of the best performer from an organic sales growth standpoint. They've been consistently delivering at the upper end of their long-term algorithm, which is 4 to 6% organic top-line growth. And what drives a lot of their growth is mainly the international business, right? Obviously, there's a lot of focus on North America, but the reality is Coke is like over 70% of their revenue is outside of the U.S. And so, and about 40% it comes from emerging markets. And that's where really the growth of the business comes in countries like Brazil, Mexico, Latin America, Asia Pacific in general. There's still significant per capita consumption opportunity in those countries. And so that's really where they grow volumes and value. Within the US and more developed markets, their strategy has been more try to drive revenue growth, right? Over the last 5-10 years, what they really try to do is they realize that there's been a shift away from carbonated soft drinks. And so they focus more on revenue growth, offering smaller pack sizes, smaller cans, mini cans, to allow consumer for more portion control and realizing better price per unit. So they're still able to grow revenue, even though volumes might not be growing as fast. And they use this strategy to diversify their business in North America. So they bought some assets like Fairlife in the dairy space and protein space that are actually growing very nicely to diversify their portfolio exposure in North America and other developed markets.